The thing is, I'm looking at this data and suddenly it occurs to me, a lot of stocks seem to be losing money. Lots of people would like to be able to predict those stocks in advance. I can, of course, give the flippant answer that if I knew the answer, I wouldn't have to work. If you're trying to identify these big winners in advance, recognize there's a lot of other smart people trying to do it also.
Hank Bessembinder, welcome to The Long-Term Investor.
Thanks, Peter. My pleasure.
I have been a big fan of your work. Longtime listeners of the show have heard me reference research you've done on individual stocks. What prompted me to reach out was one of your more recent papers, 100 Years in U.S. Stock Markets. And we're going to get to that. We're going to touch on a lot of the work that you've done, but let me start here. There's an interesting stat that I pulled out of one of the papers. The U.S. stock market created about $91 trillion of shareholder wealth over the last century, yet most individual stocks failed to beat Treasury bills. Do you think that's the simplest way to summarize the paradox at the heart of your work?
Yeah, I think that goes right to it. The stock market as a whole, in the long run, has been a tremendous wealth-generating mechanism, while at the same time, most stocks underperform. Most stocks in the long run lose money. That's a little bit of a counterintuitive finding. It seems like a few people are still resistant to it, but that's the reality.
What prompted you down this kind of path of research that, this is not new, you've been doing this for quite some time, and what made you take note in the first place?
Well, it was a little bit of an accident. As you observe, I've been working in this area for, I guess, close to 10 years now, but it's not where I was working for most of my academic career. I was doing more traditional things, studying factor investing, studying rules for trading and trading costs and such. So this detour into long-run stock market performance and skewness, a term I'm sure we'll talk more about in the next few minutes, was a little bit of an accident, and the answer is a little bit techy. But I was doing a fairly routine study with some co-authors. It involved quite a few stocks over quite a few years, and for some technical reasons, we were looking at continuously compounded returns, logarithmic returns. And I just happened to notice that for this pretty big sample of stocks, the average logarithmic return was a negative number. And I'm just not used to seeing a negative average return for a big sample of stocks. And the techie thing here is the thing about logarithmic returns is you can add them up cleanly. And then if you want to convert it back to real returns, you have to do the so-called antilog. I warned you, it's a little techie here, but that doesn't change the sign. So the thing is, I'm looking at this data and suddenly it occurs to me, a lot of stocks seem to be losing money. And so it was that aha moment of I'm looking at some sample statistics that make me say it looks like a lot of stocks are losing money. And then I started digging, and I've been digging for 10 years since. And that was right. A lot of stocks are losing money.
Well, let's dig into that a little bit. So your most recent version of the research looks at nearly 30,000 individual stocks dating back to 1926. And the average individual stock return is very attractive, but the median, that middle outcome, is negative. So for a listener who has never thought about skewness or maybe doesn't even know what skewness is, how would you explain that?
I think the reason this is counterintuitive and in some sense foreign to a lot of people is that we're used to things being kind of symmetric. There's even the bell-shaped curve, the normal distribution that shows up in statistics a lot, which is a symmetric distribution. And that's what we run into in many walks of life. So let me just take an example. I like this one because I'm of Dutch heritage. And as you may know, there's some studies saying that Dutch people are on average the tallest. So that's why I kind of like to use this for the example. But let's talk about the height of Dutch men. Average right about 6 feet. There's going to be a lot of Dutchmen that are close to 6 feet, right around the average. And then as you move away from the average, there's fewer. You take it up to 6'5", there's not as many. Take it down to 5'5", there's not as many. But it's still kind of symmetric. You take it down to 5 feet, And up to 7 feet, there's almost none in either direction. So that's what a typical symmetric distribution looks like. You have an average, and then things are kind of grouped around the average with fewer outcomes as you get further away from the average in either direction. And that's kind of what we're used to most of the time. For compound long-run outcomes in the stock market, it doesn't look like that at all. In terms of our example with height, it's more like the average is 6 feet, but most of the people are under 2 feet. And the only reason we have a 6-foot average when most people are under 2 feet is that we have some people who are 35 feet or 150 feet. That's skewness, or if you prefer, really just asymmetry. Those are reasonably substitutable terms. What we have in stock market outcomes is asymmetry around the average.
And so, I mean, really just a couple winners lift the whole boat. Is that fair?
Yeah, essentially. I mean, the only way you can have that the overall market does quite well, we have a very substantial equity premium. The overall market does quite well while most stocks lose money. The only way those can both be true at the same time is that you have a relative few that are doing great and are pulling up the average to where the average is not representative of the typical stock. So that's what's going on in a nutshell.
I'm going to butcher some of these stats probably a little bit, and so you correct me where I'm not getting it right. But you reference shareholder wealth creation from individual stocks and how just such a small percentage, like 0.5% of all stocks, I can't remember if it's created half of the shareholder return or maybe it's all of it. I mean, maybe explain that. There's buy and hold returns. I think that's what a lot of people think about. But there's this other metric that you're looking at, shareholder wealth creation. Can you unpack that a little bit?
Yeah, sure. And let me just broaden it a little bit. One of the recent papers I wrote after having been thinking about these issues for 8 or 9 years is titled, "How Should Long-Term Outcomes to Investors Be Measured?" And it's not as obvious as you might think. You know, we have some measures that are relatively familiar, but it's not entirely clear that those familiar measures are the best or the right way. So a buy and hold return is a pretty simple thing, and the name describes it. If somebody just put some money in and didn't trade anymore, there's one technicality there. You have to be reinvesting your dividends to earn the buy and hold return if they're computed from returns that include dividends. But other than reinvesting dividends, the buy and hold return is just what the name says. So that's a simple thing, and I report it, and it's informative to know how that turns out. But the thing is, we're not buy and hold investors. Almost nobody is. We either add to our investments from time to time, or we pull money out of our investments from time to time. And here's a really important distinction. One investor hypothetically could be a buy and hold investor, but the group of investors, the body of people who invest in the stock market, are not buy and hold investors. How do we know that for sure? Because firms do primary transactions. They issue shares, they repurchase shares. And shareholders, investors in aggregate, are on the other side of those transactions. And for that matter, collectively, we don't reinvest dividends. That idea sometimes surprises people because it's so easy for any individual to reinvest dividends. But if I reinvest my dividend, what I'm doing is buying some more shares. And that requires that somebody else sells shares. My buying some more shares doesn't put the money back in the company. So anyway, collectively, we don't reinvest dividends. So anyway, this second measure that I have in most of my papers, shareholder wealth creation, it differs from buy and hold returns in two key ways. The first is it takes size into account. Other things equal, a big investment, a 5% return on a big investment involves more dollars than a 5% return on a small investment. So it takes size into account. And then it takes into account that it takes the perspective of shareholders in aggregate. So not a buy and hold perspective, but a perspective of investors who did participate in share offerings, did participate in share repurchases, et cetera.
As you were saying that, I looked up the stat that I knew I was going to butcher, and I did. I did butcher it. So we'll get this correct this time. But the paper of yours about a decade ago that a lot of people like myself latched onto looked at all of the existing U.S. listed, existing and historical past listed companies from 1926 through 2016. And at that point in time, there were 90 firms that accounted for half of this net shareholder wealth creation that you captured. Now, we fast forward to the present, and you see that same number is covered by only 46 firms. So, like, what has changed? That's a big change. And first of all, actually, let me step back. First of all, let's acknowledge that just a very, very small portion of individual stocks drove most of the wealth creation. And so, maybe an obvious takeaway for diversification and owning a little bit of everything is that if you don't own a little bit of everything, the risk of missing where all that wealth creation is coming from is quite large. The other thing that stands out to me, though, is data sets don't typically change that much in such a short period of time. So go either way you want with either of those takeaways from myself. I'd just love to get your thoughts on those items.
Sure. So there's a couple of things there. One is the desirability of diversification. Let's maybe come back to that in a minute because it's a topic that deserves its own focus. But the concentration of wealth creation. So let's take it in two steps as you did. In the original study, I documented what I thought and what most people thought was a remarkable degree of concentration in wealth creation, with a relative handful of firms accounting for half. And there was another statistic, about 4% of the firms accounted for all of the net wealth creation. So I was surprised. I think a lot of other people were surprised at how concentrated the wealth creation was, how few firms were driving it. The second thing is there's only 9 years of additional data. The first study had 91 years of data. Now we're up to 100 years of data. But in only 9 additional years, the number of stocks that account for half of the wealth creation decreased a lot, or more or less was cut in half. So that's really striking as well. In terms of what changed, this is something that is not yet in a paper that I've circulated publicly, but it's in a paper that I expect to post publicly probably within a week or two. But what's changed is that if you went back over the last 60 or 80 years and said, instead of buying everything, I'm going to buy just the biggest stocks, maybe the single biggest stock, maybe the 10 biggest stocks. For most of the last 50 or 60 years, that has actually not worked out well. But it changed at about 2013. And since 2013, it's worked out very well. The big firms have outperformed since about 2013. And in a nutshell, that's why we that unusual pattern where the big firms outperform by quite a bit that has shown up in the last dozen years is why we've seen this sudden acceleration in how concentrated the wealth creation is.
People are going to recognize some of these big names: Apple, Microsoft, Alphabet, Amazon, NVIDIA. I believe it's NVIDIA that had the highest annualized return among stocks with more than 20 years of data. Altria, which if you're those who are not familiar, is the tobacco company. I shouldn't say cigarette. We'll call it tobacco. It sounds a little more refined and sophisticated.
It was Philip Morris before it was renamed, which will be familiar to many people.
Yes. Yeah. So, when we look at those, what does that contrast teach us about time in the market versus just spectacular annual returns?
Well, first of all, let me just say that the two stocks you mentioned, NVIDIA and Altria Group, are really remarkable outliers in terms of the percentage returns that they've delivered for their shareholders. Altria Group has done it over a longer history than NVIDIA has. So one of the things that was striking to me was that the companies that have the highest cumulative buy and hold returns, and in the case of Altria Group, I'm going a little bit from memory here, but the number is something like 400 million%. It's one of those numbers you have to actually sit back and think about. Now, what exactly is that big number? But it did it with, I've got the number right here. It did it with annual returns of 16.5%. over 100 years. So one of the lessons is, we don't really want to say only 16.5%, but 16.5% over 100 years compounds to something amazing. I think I used the phrase that was only moderately high on an annual basis, but give it 100 years. Now, Nvidia, on the other hand, they haven't been listed for nearly as long. Nvidia has generated 37% per year. And as you said, that's the highest of any stock that's been there for at least 20 years. So that's an amazing record as well. But there's no stock that has continued that level of performance for longer horizons. And, I'm not making a call on where NVIDIA is going next. I'm just saying it's not going to deliver. It's very, very unlikely it's going to deliver 37% per year for the next 25 years. Just history says that those really big numbers just don't persist in the long run.
Ian, I'll be sure to link to this in the show notes at thelongterminvestor.com, but there is some data that alongside Hank's study, I've always seemed to pair them together, that like what happens in the 1 year, 3 years, 5 years, 10 years before a stock becomes a top 10 stock, and then what happens after that. And it sounds like perhaps some of your research will go into some of this as well, but look, you become the biggest stock in a given market or the world by performing well. And if NVIDIA is around for the next 100 years, obviously Hank and I will not be, but somebody will be talking about this. If it's compounding for 100 years at a more modest 16% as opposed to 37, then yeah. But I think what you call out is what I tend to believe, that the big winners, you can't keep growing at that pace. There is some sort of barrier to that. The other thing that sticks out to me that I referenced earlier is just the case for diversification. I mean, I don't think investors could reasonably expect to identify these huge winners in advance. I mean, is that the main lesson here?
It's definitely a lesson. And, you touched on what for most people is probably the biggest question. They say, okay, wow, you showed us that a few firms are really big winners. Those pull up the overall market. How do I identify those firms? And, I can, of course, give the flippant answer that if I knew the answer, I wouldn't have to work. But the thing is, it's not easy. Lots of people would like to be able to predict those stocks in advance. And, I'm not necessarily one of the high priests of the market efficiency theories. And I use that only slightly tongue-in-cheek. When I was a younger academic, market efficiency was almost a religion among academics. Anyway, there's a lot of debate about how efficient are the markets, and I don't want to necessarily wade into that debate, but it's competitive out there. I mean, if you're trying to identify these big winners in advance, recognize there's a lot of other smart people trying to do it also. So for most people, I really think that my studies just reinforce the desirability of diversification, broad diversification. For everything you've already heard, everything that's in the textbooks. And then on top of that, if you're just picking stocks at random in a skewed distribution, your odds are not 50-50. If you pick some stocks at random, the odds are against you. You're probably going to underperform. Now, of course, people will say, but I'm not picking stocks at random. I'm picking the good ones. But now we're back to, so's everybody else trying to pick the good ones. Are you better than the really smart people you're competing against in that endeavor? But that said, there are a few people with the right skill. It's probably just as well that nobody told Warren Buffett he shouldn't try. The problem is, there's more people who think they're the next Warren Buffett than there are people who are actually the next Warren Buffett. And for the rest of us, how do we tell?
Well, and even Warren Buffett himself says if he had to start all over right now, today, although he maybe said this a few years ago, he wouldn't be able to replicate the success because the competition is just so high. For whatever it's worth, I know it's hard for academics to wade in on one side of market efficiency versus not. You academics, you take your debates very seriously, whereas here I am, I'm just an allocator. I can say whatever I want. So I will tell you on a scale of 1 to 10, with 10 markets being perfectly efficient and 1 them being perfectly irrational, I'm probably they average like a 7 or an 8 or something like that. I think in general, markets are really good at pricing things, but occasionally us humans, we get a little crazy. As we think about picking individual stock winners, though, I think a growing number of investors, if you take a little bit of time to educate yourself on your competition, as well as just how markets work, I think in general, people who are watching us or listening to us right now, probably in that camp that it's really hard to own individual stocks, but they might still do it because it's fun, becomes part of identity. And maybe you do feel like you have some unique either piece of information or unique way of interpreting the same information that everybody in the world has. But let me ask you this. For investors who own individual stocks, do you think the bigger challenge is finding the winner, holding the winner, or not selling it too early?
So I don't have a simple answer for you there. For a few years I was a consultant to a firm called Baillie Gifford. They're a Scottish investment manager, and they're not a broad diversification firm. They're a narrow long-term investing firm. While I do think that most people should have diversified portfolios, I don't think absolutely everybody should. I think the capital markets need some investors with conviction, some people that are willing to hold narrow portfolios in the long term. But one of the things that I tried to work out with them or discussed with them was exactly this issue. They had succeeded in picking some of the firms that have ended up on the leaderboard. And then the question is, well, in real time, do you sell to lock in your gains, or do you continue to let it ride in the possibility of future appreciation? And there too, it's competitive, and there's no easy answers. No simple rule that's going to work reliably. It really just comes down to when I teach valuation to my MBA students, I try to convey to people that, the relatively few people who are going to have the right skill, the right comparative advantage, are people who can both marry the quantitative models, discounted cash flow and other tools, with really good intuition about business prospects and growth prospects. And it really comes down to, using that combination of quantitative tools and intuition to try to ferret out whether the market has fully incorporated in the today's values of this company's long-run growth prospects, or have they overshot, or have they not yet incorporated it? And there's not going to ever be any simple way to answer that. But that's the essential issue, the essential question.
Yeah, I appreciate that framework. I think of it similarly. Like you can have the intellectual horsepower, but you also have to have some sort of pulse on the psychology of the overall market or the place you're investing. And I started my career as an analyst that researched individual stocks and made stock picks. And when I look at those that did really great, a lot of them were based on a story that I made about the data. Now, the stock might have done really well, but it had nothing to do with the story that I created. And so it's I don't want to get tripped up by compliance by naming names, but I'm going to try this anyways. We'll see if it ends up getting cut out. But take someone like Monster Energy Drink. I really felt like that was great for the reason that I thought Anheuser-Busch might buy it. That was really the core thesis of why I like the stock. Turns out Anheuser-Busch got bought. People kept drinking energy drinks. Heck, I had an energy drink right before this. It was not a Monster, though. It's one of these things where everyone has to come around to your viewpoint of the world. And then sometimes things turn out in your favor, but not for the reason that you said that it was going to be. So I don't know how you would judge that decision. I'm one of these people who would believe you got to judge the decision based on the inputs you had at the time, as opposed to just the outcome. But I digress. I think the framework, sorry, a little bit of a tangent there, the framework that you're laying out on what it takes to pick individual stocks in a successful manner is more than just pure intelligence. It's a number of factors that very, very few people possess, but I'm with you that it doesn't mean that it doesn't exist. There are people out there. Let me pivot back and get to something a little more practical as it has to do with your research. One thing I found curious the first time I came across your work is that you were comparing stocks to 1-month Treasury bills. which is sort of what I think of is a proxy for cash. So why choose a benchmark like that when looking at individual stocks?
Yeah, so I think the simplest answer is just that in the academic world, we are constantly focused on the idea of a risk premium. How much do you get? How much extra do you get for taking on the risk? So the idea, Treasury bills are proxy for cash, and that's what you can get without much effort and without taking risk. So the Treasury bill benchmark is mainly motivated by this idea of trying to assess how much of a premium you get for taking on the risk. I will mention, though, that in most of my papers, I also compare to a benchmark of zero for many of the metrics. So that can also be found in the papers.
Another conclusion that I find interesting, at the beginning of this year, I had a number of guests on the show and also talked to myself. I have these solo episodes, these monologues where I'm talking to myself. We were focused on capital market assumptions and the assumptions that go into financial planning models. And you somewhat warn against that, like the financial planning based expected or mean returns could be misleading because most outcomes are going to be positively skewed. We were talking about skewness before. We're talking about shareholder wealth creation, which is a slightly different topic. But how do you feel like advisors should be talking about long-term returns, either as part of financial planning or just as broad market conversation?
I think it would be good if people would talk more in terms of probability distributions, the set of possible outcomes. There's nothing wrong with talking about, we expect our forecast of the market premium is 7%. And if we compound out 7% until your retirement age, here's the number. There's nothing wrong with that. It's just incomplete. And in particular, because of skewness, when you go through an exercise like that, you're more or less trying to figure out what the mean possible, the average possible wealth will be at this target date. But in a skewed distribution, that's just one point, and it's not a representative point. There'll be a few points that are really high, but most of the possible outcomes will be lower. So, obviously a lot of financial planners will already be doing this, but if you're running simulations, you'll see it as soon as you run out your simulations that most of your outcomes are below the mean outcome. But I just think that more discussion of the median, which is the point with half above and half below, more discussion of the median and more broadly discussion of the distribution of possible outcomes would be healthy.
Yeah, that makes sense. And I mean, you sort of started to reference this, but what is a return really if the investor's goal is not just to compound wealth, but to fund spending over time? I mean, some of your work emphasizes like sustainable return and sequence risk. How does that play into this?
Yeah, so that's in the paper that I touched on briefly, the one titled more or less, how should we long-term investors' experience be measured? I'm not sure I got my own paper title exactly right there, but I got the gist of it. So, we started off by talking about buy and hold returns, which are really intuitive and are often reported. People will just call them compound returns. Really more often, especially among academics, we talk about average returns. Arithmetic averages of returns. And that's something I'm really starting to push back on more. People don't earn average returns over time. Don't earn arithmetic means of returns. So I don't think either the average return that's so often talked about, and by the way, we can talk about this more in a moment if you want, but things like alpha is an average return. It's an arithmetic mean. Neither arithmetic means or buy and hold returns are really, in my view, the most relevant number for investors. I mean, it kind of goes to the question of why are you investing? And a bequest motive is probably relevant for most investors. But if the only thing you're thinking about is how big is your portfolio on the day of your demise, well, all right, I won't fill in that sentence. But I don't think that's what most people are thinking about. Instead, people are thinking about, I'm investing now so that I can pull money out for other stuff later. Maybe it's to fund my retirement. Maybe it's to send the grandkids to college. Maybe it's to make some bequests for charitable work or to fund university research. Had to get that one in there. But anyway, people invest because they want to pull money out later. And I just think it would be a good idea if we spent more time thinking about how can we measure investment outcomes in terms of what can be pulled out later. And I'm not certainly not the first to have thought about this. Among others, John Cochrane, who's a name that might be familiar to
Sure.
To you and some of the people who listen, has also been pushing this direction. But anyway, with that in mind, one of the alternatives that we develop in that paper is what we call the sustainable return. And essentially, it's how much of the corn can I eat each period without diminishing the seed corn? How much can I pull out of it? What sequence of withdrawals can I pull out of an investment such that the final real value of the investment is the same as the initial real value? That's what the sustainable return is. And I don't want to oversell here because, there's no magic. There's still risk. This is an ex post measure, something you can only see after the fact, just like all the other return measures are. But it's a different way of thinking about how to measure investment performance. So anyway, we do the math. We lay out the math for that alternative return measure. And one of the things that pops out of it right away is that the sequence of returns matters. And for anybody who's listening who does financial planning sort of stuff, who does retirement planning, they already know this. But I've bounced the idea off of several academic audiences now. People who are smart. I was going to say consider themselves smart, but they don't consider themselves smart. They are smart and learned. But I've asked how many of you are familiar with return sequence risk, and I've yet to see a hand go up. This is real. But the thing is that the measures that we most often use, arithmetic averages of returns, and buy and hold returns, which is basically just the geometric mean compounded. You can change the order. You've got a series of returns. You can change their order. Doesn't change the arithmetic mean, doesn't change the geometric mean or the buy and hold return. But as soon as you have money coming in or out, the ordering matters, and it can be really important. So I actually think that return sequence risk is a risk that matters in practice, but somehow hasn't mattered in theory, which suggests to me something's wrong, some incompleteness in the theory.
You just need more academics approaching retirement to start worrying about the sequence of return risk that you're right. I think advisors have long thought about. I get the sense that advisors who had clients retire just before like the great financial crisis or during it, maybe they're overly biased towards protecting against that sequence of return risk.
Nothing makes something so salient as living through it.
The long term feels like an eternity in the moment when things are going wrong, without a doubt. One string I want to pull on that you mentioned or referenced is like, hey, there can be investments where an arithmetic return can look good, but like the compounded long-term result can disappoint. Do you mind going into that a little bit more?
Again, at the risk of being a little techie, but it's very common to measure returns as the arithmetic average. So you measure the return, say, for each month, and then you have a bunch of months and you compute the average return.
Right. And so let me dumb it down even more. So 50 months of returns, you take the 50 returns, you divide by 50, you got your arithmetic return.
Mm-hmm. Yep,
Geometric,
exactly.
I don't know how to calculate other than using Excel. So I'm curious to hear how you put this one out into the world.
Yeah, well, geometric is, it's not the simplest thing in the world to explain, but you basically figure out the buy and hold return. If I just let it sit there, what did it grow to? And if there was 50 months, what did it grow to over 50 months? You basically then take the 50th root. You take it to the 1/50th power, which is easy to do in Excel or on a calendar or on a calculator. But that's what it is. The thing is, the geometric mean directly determines the buy and hold return. They're opposite sides of the same coin, so to speak. The arithmetic mean doesn't map cleanly into anything that's an actual investor experience over multiple months. It's just a simple number to compute. Arithmetic means are potentially misleading. And by the way, they're always higher than geometric means. except if there's no volatility at all. And the more volatility there is, the bigger drag, the bigger difference there is between arithmetic means and geometric means. Some people call that difference volatility drag. In any event, arithmetic means they don't map cleanly into any long-run outcome. You should not compound arithmetic means. They will overstate outcomes. Despite that, much of what we work with in quantitative finance is based on arithmetic means. Alpha is an arithmetic mean. Sharpe ratios are based on arithmetic means. Anybody who's doing mean variance optimization is focused on arithmetic means. There's just kind of a disconnect between these measures and the reality that investors don't earn arithmetic means over multiple periods. So anyway, one of the places where this shows up, and I documented it in a paper on mutual fund performance, is that a fund can have a positive alpha, but still underperform benchmarks in terms of compound returns. And it just comes down to the difference between a geometric mean and arithmetic mean. And I was describing this once in an academic seminar, and somebody said, "But everybody knows that." Everybody in the academic audience knows that. And I said, "Yes, but we still report arithmetic means." So there's the rub.
Yeah, well, and advisors or allocators like myself. So in my firm, as of this recording, manages a little over $10 billion for clients. And when I get pitch decks, whether it's for a factor or I'll call hedge fund strategy that is generating alpha, like all of the alpha is presented in arithmetic average. Now, there's also sometimes differences between the research and the actual implementation, totally different can of worms there. But I think it's really important to understand that not even advisors themselves, not even allocators themselves will always delineate those two, which is why I appreciate the work and part of why I asked the question. I will say, Hank, though, that it's not a podcast these days if you don't ask about AI. We've talked a little bit about sort of the winner take all outcomes of the individual stock place. I'm just kind of curious to get your perspective on whether artificial intelligence accelerates that, which way you lean on the issue.
I think you know that I ended my most recent paper with the question: Will AI accelerate the tendency towards concentration in wealth creation, or will it reverse it? And I posed it as a question because I genuinely don't know the answer. I think I think it's clear AI is going to change the world. But, we can all agree on that. It is changing the world and it's going to continue to change the world. We can all agree on that and still not be sure what that means for valuations and stock market outcomes. There's so many moving parts here. But let me just lay out some of them that I don't think get enough attention. The first one is just who captures the economic rents. And if not everybody is familiar with that phrase, economic rents, who gets the excess profits? If anybody, I can imagine an outcome where AI becomes kind of like a commodity. It's really a question of, how competitive is the market for AI services? And do the various vendors end up putting out AI products that customers view as broadly substitutable for each other? If that's where we end up, then the AI companies themselves are not necessarily very valuable companies. So you can change the world without being valuable. And, I don't know how that'll play out, but I imagine the people at the AI companies are thinking about that. How do we keep our product differentiated from the competitors? That's one question. And then there's questions up the supply chain. So we talked about NVIDIA, as a supplier of chips for AI. Do they maintain their monopoly position and their super competitive margins, or does competition encroach on them? I mean, I don't know the answer, but there's just a lot of big questions out there. And then another question is, in a world where AI services are broadly available and perhaps competitively priced, I mean, they seem really cheap to me currently. But when these services are available to everybody at low prices, does this make it easier to start up new businesses? Does this, in some sense, level the playing field? I can imagine that as a possible outcome. But the truth is, I have questions, not answers, on these issues.
Well, like I said, we'll have to check back in another 100 years on some of these items. Why don't we finish off, though, with just some more broad wisdom? You studied markets for decades. And if this makes you repeat yourself, so be it. I mean, are there any lessons that you feel like smart investors still resist the most, despite the evidence that's out there?
Well, believe it or not, the point that we started with, that most stocks lose money, some people seem to be resistant to it. I'll confess that I'll occasionally do a Google search just to see what people are saying out there about these papers. And there's a handful of people who don't believe it. If somebody says, Bessembinder did it wrong, and other people said, I knew it all along. They're oddly,
that's the internet for you. Yeah.
They're oddly silent about what it is I did wrong. But anyway, some people are ready to jump on it. Oh, I knew there was something wrong here. So some people are just resistant to the idea that long run stock market outcomes are skewed, asymmetric, but they are, and they will be. I've mostly worked with the data, document the outcomes, but there's a couple of talented fellows in Sweden, Farrago and Hamarlison, I believe are their names. You can find reference to their work in my studies, but they've worked out the math in incredible, rigorous detail, showing that this is going to be the universal outcome, the asymmetry, and we see it. I document it for the public markets, and the very first time I presented this, I presented this line of research. I said to the audience, I said, look, I'm going to tell you about an asset class where most of the investments lose money. As a matter of fact, the single most common outcome is to lose essentially all your money. But there's a few really good outcomes, 10 baggers, 50 baggers, 100 baggers. And those few make this investment class worthwhile. And you might respond, but I already knew that about venture capital. Well, the thing is, what venture capital and the public markets have in common is the compounding of random returns. And these findings are hardwired in the compounding of random returns. So they will be there, and it is a real phenomenon. But some people seem resistant to the idea.
I was guest on a venture capital podcast sometime in the last 6 months, and I think I gave that exact example. I said, sound familiar? Are we talking about index funds, or are we talking about VC? Well, Hank, this has been such a pleasure for me. People who've been following the show or my work for a long time have seen me reference your work over and over and over again. So it's great to have you on, sharing your insights directly with the audience. If people want to try to keep tabs on the work you're publishing or what you're thinking, is there a best way to find you?
Well, I'm easy to find, partly because of my last name. There's not a lot of Bessembinders in the country. But the other thing is that all of my papers are freely available in the public domain, no cost for downloads. The website is Social Science Research Network, ssrn.com. So all the papers we've talked about can be found there. And as I post new work, it'll be there.
We all appreciate that your work is readily available. Again, Hank, thanks so much for joining me here today. And if you are watching us on YouTube or Cheddar or listening to us on the podcast, leave some comments. Tell us what you believe or don't believe about Hank's research. We can share it with him so he doesn't have to go to Google and look again. Seriously, though, Hank, thank you so much.
My pleasure, Peter.